So how does a company hit its first ever $1 billion revenue quarter, achieve 9 straight quarters of profitability, and yet somehow see its stock plummet by like 35 to 37% this year?
Yeah, I mean, it is the ultimate market paradox right now.
Right. Is it a screaming buy, or are we looking at a classic value trap here?
You've basically got the fundamental business performance of a company just moving aggressively in one direction, while the actual stock price is it's going in the exact opposite direction.
It's wild. Well, today we are taking a deep dive into the ledger of SoFi Technologies, ticker symbol SOFI. And real quick, before we jump in, make sure to like the video and subscribe to our YouTube channel. And it's compulsory to leave a comment with your feedback below so we know what you think.
Yeah, definitely let us know your thoughts in the comments.
So our mission today, we are going down the rabbit hole to unpack the underlying financials, translate the really chaotic technical charts driving all this daily price action, and debate the intense tug-of-war happening between skeptical short sellers and bullish insiders.
And just to throw it out there as a disclaimer.
Oh yeah, absolutely. Just to be totally clear, this deep dive is just an exploration of market data and analyst perspectives. We're here to help you understand the landscape, but this is strictly not financial advice.
Right, we are here to decode the mechanics of the market, not to manage your portfolio for you.
Exactly. So let's set the scene for where the stock is today. SoFi recently saw a pretty significant 5.1% bump in a single session, which brought the price up to around $17.05.
Which sounds great, right?
Yeah, but when you zoom out, that little bump is happening inside this massive, volatile downdraft. I mean, we are talking about a stock that is miles away from its 52-week high of $32.73.
It has essentially been cut in half from its peak. And what makes that drop so compelling is that it happened alongside some incredibly strong business updates.
Yeah, the news has been largely positive.
Right. So that means we have to, temporarily separate the underlying business from the stock ticker just to figure out the baseline.
Okay, let's unpack this. Because before we figure out why the stock is falling, we have to look at what the business is actually doing on paper.
And on paper, it's looking pretty good.
It's historic, honestly.
Yeah.
The fourth quarter of 2025 was SoFi's first ever $1 billion revenue quarter.
What's fascinating here is that crossing that billion-dollar quarterly threshold, it's a massive psychological barrier for a growth company.
Oh, for sure.
Yeah, it basically signals a transition from an experimental startup to a mature, scaled enterprise.
And looking at the full year 2025 totals, the income statement looks remarkably robust. I mean, total revenue hit $3.61 billion.
Which is huge.
Yeah. But more importantly, their GAAP net income was $481.32 million, giving them a diluted EPS of 39 cents. And for anyone not staring at spreadsheets all day, GAAP stands for Generally Accepted Accounting Principles.
Right, which means it's the real deal.
Exactly. It basically means this is real standardized profit. There's no creative math, no ignoring inconvenient expenses.
And that distinction is crucial. Many tech and fintech companies boast about adjusted earnings.
Right. The adjusted part does a lot of heavy lifting.
Yeah, they use it to strip out massive costs like stock-based compensation. So SoFi reporting real GAAP profitability for 9 consecutive quarters shows a business model that is actually generating more cash than it burns.
Then you look at the balance sheet at the end of 2025. They're sitting on $50.66 billion in total assets against $40.17 billion in liabilities.
That's a very solid ratio.
Yeah, but the metric that really jumped out to me in those fundamentals is the customer deposits. They surpassed $37.5 billion.
Wow.
Yeah.
And if we connect this to the bigger picture of how a bank operates, deposits are literally the lifeblood of the business.
Right, because it's their funding.
Exactly. When a bank has over $37 billion in customer deposits, they essentially have access to incredibly cheap funding. Instead of having to borrow money at high institutional interest rates to fund their lending operations, they can just use the cash sitting in their users' checking and savings accounts.
Which massively expands their profit margins on every loan they issue.
Precisely.
It feels like an athlete having a record-breaking career best season, right? Like they're leading the league in scoring, but the general manager keeps trying to trade them away. Why isn't the market rewarding this performance?
Well, the stock market is inherently forward-looking. It rarely rewards a company for what it just did. It prices the company based on what it fears or hopes is going to happen next.
That's just all about expectations.
Exactly. While those raw numbers show a thriving, capitalized business today, the market is heavily influenced by the broader macroeconomic context. So the fundamentals show a strong foundation, but the stock mechanics reflect a market paralyzed by the fear of what tomorrow's economy might look like.
Okay, so if the balance sheet is fortified with over 37 billion in deposits
Right.
and the company is legitimately profitable, the selling pressure can't be coming from the fundamental ledger.
No, it has to be psychological.
Right. That means we need to look at the behavioral footprint of the market, the technical charts and the latest news.
And right now, SoFi is trapped in what technicians call a falling channel.
Even with that recent 5.12% bullish pop.
Yeah, even with that, the short-term strength is nice, but the medium-term outlook remains highly cautious because the stock is trading below its major moving averages.
And those are the big trend lines everyone watches.
Exactly. Specifically, it is trading below both its 50-day simple moving average, which sits at $18.42, and its 200-day simple moving average, which is up at $23.85.
When I look at this chart, it feels like the stock keeps hitting a brick wall right around that $24 mark. But wait, I have to ask, are these indicators actually predicting the future or just reflecting the chaos of retail traders getting chopped up by volatility? I mean, why is that 200-day moving average such a heavy psychological ceiling?
That's a great point. Technical indicators don't predict the future, right? They just map human behavior and institutional algorithms. Think of the 200-day moving average as the collective memory of the market over the past year. It basically represents the average price investors paid for the stock over the last 200 trading days.
Which means if the current price is $17, but the 200-day average is almost $24, the vast majority of people who bought over the last year are currently underwater. They're losing money.
Right. Put yourself in their shoes for a second. You bought SoFi months ago, and you've been staring at a red portfolio every single day. The psychological toll of that is heavy.
Oh yeah, it's brutal.
So the second the stock finally climbs back up to that $24 mark, which is the price you originally paid, what is your first instinct?
To sell immediately,
Yeah.
just to break even and get off the ride.
Exactly. That collective sigh of relief creates a massive wall of sell orders. That is exactly why the 200-day moving average acts as such heavy resistance. It becomes a self-fulfilling prophecy driven by the desire to just break even.
And that's where the battle lines are drawn. Right now, we see historical buyers stepping in to defend the stock around the strong support base of $15.15 to $15.23.
And if it breaks below that,
The data shows a much deeper floor down at $13.77. But to push higher, it has to chew through immediate resistance at $16.23 to $16.49, while battling that psychological barrier at $17 flat.
it's a tough climb.
Yeah. But what about the momentum of the stock right now? We always hear terms like RSI and MACD thrown around.
Let's translate those. So the Relative Strength Index, or RSI, is basically a speedometer for a stock's momentum. It operates on a scale from 0 to 100.
Right.
If it goes over 70, the stock is moving too fast and is considered overbought. If it drops below 30, it's oversold. Right now, SoFi's RSI is sitting around 39.95.
So it's neutral, but approaching oversold. The selling engine is starting to cool down, but it isn't quite at the bottom yet.
Yeah, but the nuance is that we are seeing wild intraday swings pushing that speedometer up to 67.89 during the trading day before slamming back down.
That is some serious volatility.
Absolutely. Meanwhile, the MACD, which is an indicator used to measure the relationship between two moving averages to find the trend direction, is sending completely conflicting messages.
How so?
Well, the daily reading suggests a clear sell signal at negative 0.76, but the very short-term models are showing a positive bullish trend at 0.19.
Synthesizing all of that data, it sounds like a market completely paralyzed by indecision. Institutions and retail traders alike just can't agree on a direction.
Yeah, that's exactly what it is.
And this extreme technical indecision perfectly mirrors the polarized ratings and negative signals we are seeing from financial analysts.
Oh, the analyst ratings are all over the place. Sell, strong sell, hold, buy.
Right. The ultimate debate right now is SoFi a truly undervalued diamond, or is it a classic value trap?
If you look at the analyst consensus, the one-year target estimate sits at $23.98.
Which suggests massive upside from the current $17 level.
Yeah, exactly. And the valuation extremes go even further. The analysis platform Simply Wallsaint claims the stock is 57.4% undervalued, calculating a fair value of $39.98.
Wow, almost $40.
Yeah. But then you flip over to Yahoo Finance and you see users and analysts arguing that the stock is currently overvalued based on its growth narrative in this economy.
Here's where it gets really interesting, though. Amidst all this debate and falling price action, we have aggressive insider buying.
Oh, this is the best part.
Right. CEO Anthony Noto just dropped over $500,000 on shares. So I have to ask, is this the ultimate vote of confidence from the guy who literally sees the internal ledgers every day, or is this just a captain trying to reassure the passengers on a rocky flight?
Well, context is everything when analyzing insider behavior. Noto didn't just buy shares randomly on a Tuesday. He made that $500,000 purchase right after a major short seller attack drove the stock price down.
So he was intentionally stepping right in front of the train.
By buying in at that exact moment, he is putting his own personal wealth on the line to counter a very specific bear thesis. It is a direct signal to the market saying, the short sellers are wrong, the internal data is strong, and I am willing to bet my own money on it.
Which means to understand why some analysts still think this is a value trap, despite the CEO's confidence, we have to look at the downside risks dragging the sentiment down.
Yeah, we have to talk about the bears.
The loudest bear recently has been the short-selling firm Muddy Waters. They released a report pressing SoFi on their accounting practices and debt transparency.
This raises an important question, though, about how financial institutions report their health. Muddy Waters took aim at how SoFi values the loans on its balance sheet.
Right.
When a bank originates a loan, they have choices on how to account for it. They can hold it for investment, or they can mark it to market value. Muddy Waters alleged that SoFi's accounting choices were masking the true risk of their debt.
Now, it is important to note that SoFi has labeled that short report as completely deceptive and defended their accounting. But in the stock market, perception is reality.
Exactly. Regardless of who is right, the report created fear.
And fear causes selling. It's like looking under the hood of a shiny new car and finding some frayed wires. But beyond the accounting debates, there is a very real, tangible macroeconomic concern here. Credit quality.
Yeah, this is the big one.
We are seeing rising delinquency rates across SoFi's personal loan portfolio. Could you clarify how rising delinquencies in personal loans could threaten that massive $50.66 billion asset pile we talked about earlier?
Think of personal loans like the foundation of a house. We just talked about SoFi building this massive skyscraper of assets. But a huge chunk of those assets are unsecured personal loans.
Unsecured meaning there's no collateral.
Right. There is no physical house or car for the bank to repossess if the borrower stops paying. The market is terrified that in a high-interest environment, a sudden spike in defaults is going to cause the soil beneath that skyscraper to liquefy.
That makes a lot of sense.
A loan is only an asset if the borrower pays it back. If thousands of borrowers start defaulting, those assets have to be written down on the balance sheet. They literally evaporate.
Wow.
So the bear case argues that SoFi, despite all its flashy app features, is fundamentally still taking on serious borrower risk.
And that dynamic explains why everyday retail traders often get trapped here. They see the stock drop from $33 down to $17, and they think, oh, it's on sale.
Yeah, they buy the temporary bounce.
Exactly, thinking they caught the bottom. But then the macro fears regarding loan defaults drag it right back down into that falling channel. It's a classic trap.
It is incredibly dangerous for retail traders. When you buy into a chart like this, you are stepping onto a battlefield between massive hedge funds shorting the stock and institutional bulls defending it.
But despite those frayed wires, the engine is still churning out record horsepower. We need to look at the best-case recovery scenario. What is the bull case?
The bull case hinges entirely on diversification. SoFi is seeing massive growth in what is known as capital-light fee-based revenue.
So what does this all mean? What does capital light actually mean for them?
Traditional lending is capital-intensive. You need money to lend money, and you take on credit risk. Capital-light revenue is the opposite. It comes from software infrastructure and transaction fees. For SoFi, the crown jewel here is their technology platform, Galileo.
Right, they provide the back-end API plumbing for the broader Fintech industry. Every time a user swipes a card on a startup's app powered by Galileo, SoFi collects a fee.
With zero credit risk. Plus, they are rolling out big business banking, which integrates traditional fiat currency and crypto capabilities for large enterprise clients.
Which brings us back to that crucial fourth quarter 2025 milestone, marking their 9th consecutive quarter of DApp profitability. They are a genuinely profitable hybrid of traditional lending and high-margin software.
And that consistency is what the bulls are clinging to.
So, first quarter 2026 earnings are fast approaching on April 29, 2026. Can you contrast the short-term outlook with the long-term perspective here?
The short-term noise is entirely driven by fear of loan defaults and technical downtrends. But the long-term perspective relies on SoFi being valued as a high-margin tech platform.
So the bears want to value it as a risky traditional lender, and the bulls want to value it as a tech company.
Exactly. The April 29th earnings report will be the next major battleground for those two narratives.
To recap the core tension for you listening today, you have a company with phenomenal, historic, $1 billion fundamental growth, clashing with heavy technical resistance and intense short seller skepticism.
It really is the ultimate test of conviction.
It leaves us with a pretty provocative thought to mull over. If SoFi is successfully bridging the gap between a traditional bank and a next-gen tech platform with fiat and crypto, is the market punishing them because they are failing at being a bank, or because Wall Street simply doesn't know how to price a company that is entirely rewriting the rules of finance?
A question the upcoming earnings report will hopefully answer. Thank you all for exploring the mechanics behind the headlines with us. Keep looking past the surface noise and keep questioning the consensus.
Thanks for joining us for this deep dive, everyone. We will catch you on the next one.